Okay, good morning. My name is Gavin Leo Smith. I'm going to be stepping in for Donnie De Lange. He's feeling a bit under the weather this morning. So I'm going to start off with the nature of the business, then I'm going to move on to our recommendation, then a financial review, divisional review, company guidance, corporate activity, and lastly, the portfolio guidance. So looking at the nature of the business, so Tsogo operates in the hotels and gaming industries. The gaming is the largest part of their revenues. So their portfolio consists of 14 casinos and 100 hotels, and this spans across South Africa, the rest of Africa, Seychelles, and the Middle East. This is just a corporate structure. You can see that Hoskin Consolidated Investments, or HCR, is a controlling shareholder of Tsogo. They own 51%. Now moving on to the recommendation. So we believe that the share offers value on both an absolute and relative basis. It's trading on a historic PE ratio of 10.5 times. It's also underpinned by an attractive historic forward to the dividend yield of 4.5%. However, given the high operational gearing, we do believe that investor sentiment will likely remain poor, as an improvement in consumer sentiment is essential to drive earnings higher. The timing and the extent of an improvement, however, is still uncertain at this stage. Their gaming operations are highly geared to the consumer market, and the hotel division is also highly geared to the corporate market, and these are both areas that are currently under pressure. Their operations are highly cash generative, but their balance sheet has come under a bit more strain given the investments that they've been making as part of their growth strategy. We do believe that it will become increasingly difficult for them to sustain such a high level of investment. However, these investments do position them favorably for when the domestic economy improves. Okay, now looking at the financial review. So Tsogo delivered a subdued set of results for the interim period ending September 2017. The weak macroeconomic environment put pressure on consumers. Revenue increased by 1% to 6.4 billion. This was due to a 3% reduction in gaming win, which is 56% of the revenues, 2% increase in the hotel room revenue, which is 23% of the revenues, a 9% growth in food and beverage revenue, which makes up 12% of the revenues, and also strong growth in property rental income, which is only 3.5% of the revenue. Adjusted EBITDA increased by 8% to 2.1 billion. This was in line with the increase in adjusted operating profit to 1.7 billion. This resulted in a higher operating margin of 26.3%, which is up from 24.6% in the comparable period. The net finance cost increased by 14%. This was due to additional investments in their growth strategy. Adjusted headline earnings per share fell by 11% compared to the 8% growth in operating profit. This was due to the increase in net finance expense, a higher effective tax rate, and an increase in profits attributable to non-controlling interests. And then lastly, they left their gross interim dividend unchanged at 34 cents per share. So moving on to their divisions. This just gives you the splits of operating and profit per the operating segments. So you can see, as I mentioned earlier, that the gaming operations are the largest part of their business. This is followed by the South African hotels and then the offshore hotels. So starting off with the gaming operations, it contributed 69% to revenue and 73% to EBITDA. This slide just shows their assets across the different provinces. Revenue decreased by 2% to 4.4 billion. Gaming win declined by 3% to 3.6 billion, with slot and table wins down by 1% and 9% respectively. The high-end privé market performed poorly, as well as the main floor business, which also remained under pressure. EBITDA fell by 7% to 1.6 billion, and this resulted in a lower EBITDA margin of 36%, which is down from 38.2%. The margins did, however, benefit from good cost control, which helped offset some of the slow growth in gaming win. Then just looking at the provincial performance, Gauteng recorded provincial gaming win growth of 1.4%. Gold Reef City performed similar to what was seen in the prior period with gaming win growth of 1.6%. Silver Star and Monte Casino disappointed, with gaming win down by 8% and 10% respectively. However, the impact of the opening of Times Square in Mainland by Sun International did have a lesser impact than originally anticipated on both of these properties. Then in KwaZulu-Natal, provincial gaming win was up by 1.4%. Suncoast, the Golden Horse, and the Black Rock casinos saw reduced gaming win of 1.2%, 0.8%, and 11.9% respectively, and this was mainly due to disruptions to the local manufacturing industry in these areas. Mpumalanga recorded a reduction in provincial gaming win of 0.2%. In Notwendi's casino gaming win was only up by just less than 1%, while the Ridge Casino reduced by 3.4%. This was also due to the local manufacturing disruptions in the area. Then in the Eastern Cape, provincial gaming win was down by 1.1%. Hemingway's gaming win fell by 1% due to a challenging economic environment in East London. In the Western Cape, there was a slight increase in gaming win of 0.2%. There was, however, relatively good performance in the province, with the Caledon, Garden Route, and Mykonos casinos delivering gaming win growth of 2.6%, 1.7%, and 10.6% respectively. The group is still engaged in the bid for the relocation of one of its smaller licenses to the Western Cape Metropole. They do believe that this is quite a significant growth prospect. And then lastly, the Goldfields Casino in the Free State reported a 1.3% increase in gaming win, and this was despite difficult trading conditions. And looking at their hotels, revenue increased by 10%, with room revenue up by 2%, revenue per available room down by 2%, and a 6% increase in the number of rooms sold. So overall occupancies were higher at 62.8% compared to 61.7% in the previous period. So the Hotel South Africa, they contributed 27% to revenue and 25% to EBITDA. Overall industry occupancies were relatively flat at 62.3%. The group's portfolios, or Tsogo's portfolios, outperformed, with occupancies up to 64% from 62.9%. Revenue increased by 15% to 1.7 billion. And this was supported by the opening of Sun Square and the Easy Stay City Boyle Hotel on the 1st of September 2017. The opening, as well as the consolidation of the Hospitality Property Fund. Revenue per room remained flat on the back of a 2% decrease in room tariffs. EBITDA grew by 21% to 550 million, which resulted in an improved EBITDA margin of 32%. Then looking at their offshore hotels, so the business contributed 4% to revenue and 2% to EBITDA. Revenue fell by 17% to 279 million. There is some forex headwinds in here with the strengthening of the rand. EBITDA before forex movements declined by 43% to 47 million, which consequently resulted in a lower EBITDA margin of 16.8% compared to 24.3%. So as part of their property strategy, Tsogo acquired a controlling stake in the Hospitality Property Fund, and then in return the Hospitality Fund acquired some of Tsogo's hotel portfolio. So this just shows the brands under the Hospitality Property Fund. You can see in the luxury category, the upscale, mid-scale, and economy. So then just looking at the underlying performance of the Hospitality Property Fund, occupancy rates were up slightly to 61.4% from 61.2%. The average room rate was flat. However, revenue per available room increased by 0.5% to 608 Rand. They also acquired additional sections of the Sands and I, and this was done for an aggregate purchase consideration of 302 million Rand, consisting of 271 million in cash and 31 million in shares. Moving on to the company guidance. So management do have quite a negative outlook for the year ahead, given the weak state of the local economy. Um, Growth will remain dependent on a recovery in the local economy, which comes together with political uncertainty. They have highlighted that their ability to continue to pursue their growth objectives is dependent on the outcome of various proposed changes to the regulatory environment. They do operate in a highly regulatory environment, which is quite a challenge. Despite these challenges, they still remain highly cash generative, and management is confident that they can continue to generate returns from their growth strategy once the economic conditions turn. And just looking at some of the developments in their gaming portfolio, so they're busy with a redevelopment at the Suncoast Casino. This consists of a new privé, the refurbishment of the existing main floor, new restaurants, structured parking, a barnyard theatre, and the dome venue. This comes at a project cost of 1.6 billion, of which 300 million they've spent to date. The privé is scheduled to be opened during June 2018, and the completion of the remainder of the project by December 2018. Then just an update on the Western Cape Metropole. So Sun International has launched a court action to set aside the Western Cape's government to allow this relocation. However, the group has also launched a court action to compel the Western Cape government to allow this action. And as I mentioned earlier, this is a very big growth prospect for them should it come through. Then looking at Monty Circle and Monty Place. So buildings A and B were completed, of which Tsogo committed 29 million and 39 million rand respectively. The construction of building C commenced in February 2017, of which Tsogo has committed 44 million rand. And moving on to their corporate activity. So Tsogo entered into an agreement with HCR, which is their controlling shareholder, and Nivius to acquire the entire shareholding of GameCo. GameCo is a holding company of certain gaming businesses inside the Nivius group. They have already acquired a majority stake in GameCo from HCR. This was done through the purchase of shares. Now they are looking to acquire the remaining interest from the non-controlling shareholders through a combination of cash and shares. The total purchase consideration is valued at 28 Rand per share, or 4.5 billion. So this includes the controlling interest they've already taken, as well as the non-controlling interest they are looking to take. Then lastly, just to have a look at our portfolio guidance, the share has a weight of 19 basis points in the JSE Caps Fix All Share. As we mentioned in the recommendation, we do believe that the share offers value, so we therefore recommended an overweight position with a recommended portfolio exposure of up to 5.2%. Before I conclude, can you please just take note of the following disclaimer? Also, if you would like to submit questions, you may do so now. I won't be answering them live, but we will get back to you via email. And that concludes the webinar. Thank you very much for listening, and enjoy the rest of your day.